Howdy there, folks, and welcome into a brand new video on the brand new channel. This one I'm excited to get into. I haven't watched it yet, but it seems like it's going to be an interesting one. Big Short trader Danny Moses, which if you've ever seen the movie The Big Short, you remember that name, warns it's early stages of earnings cuts and massive layoffs. So I want to hear what he has to say here. Want to go through it. Give my obviously 2 cents on this, and yeah, hope you guys enjoy this. As always, thank you for being subscribed, everybody. I think we just hit 5,000 subscribers on this channel, so I appreciate all you guys joining me. I didn't expect the channel to kind of build out this fast. I think I've only mentioned it maybe once or twice in the main channel. So I appreciate you guys joining me, and let's get into this.
Street is still too bullish ahead of the CPI report. Danny Moses of the Big Short fame is founder of Moses Ventures. Danny, good to see you in person here at the NASDAQ market site.
Great to be here. Thanks for having me.
Are you net short in your portfolio? I mean, is that how you view the world?
I would say I'm not net long. I think there's opportunities. There's always opportunities on both sides of the equation, but the stuff I'm seeing right now, I think it's presenting it's set up for a short. So.
Okay, so what do you see happening tomorrow, and what are your concerns?
I think the obsession with every print that goes by with all this economic data, whether it's 8.7, 8.4, PPI on Wednesday, whatever that might be, is really about what's going on behind the scenes, and that's what's important. Earnings are coming down. Layoffs are starting to happen. Fed rates take a while to build themselves into the economy, and it's happening now. So we've seen peak earnings in this cycle for sure. We've seen probably the lowest rates in this cycle for sure. And what you guys were talking about earlier that really resonates with me is you would want to see 10-year yields now moving higher, not lower, because it's telling you something. So a 2-year, 10-year inverted by 50 basis points is telling you something. 2 negative quarter GDP growth is telling you something. And purchasing power is diminishing because the consumer is not keeping up on their wages with. So that's a bad witch's brew, as we say.
Witch's brew. He snuck in here, by the way. I'm sitting here.
Yeah, so I mean, obviously, if it's anybody in relation to the Big Short movie and that whole gang, they always are going to come from more of a skeptical angle and more of a shorting angle for the market, like pretty much almost always. That's just the way those guys are, Michael Burry, that whole group. So I think that's just important to kind of understand. Now, a point I wish he would have made out there that I think was very important is, he was talking about, if, CPI number had come in at 8.7, 8.4, or, whatever the number was, right? I wish he would have made the point essentially about, like, no matter what, the number is still ridiculously high, which I think is very, very important. Like, we came in at 8.5, right? 8.7 was expected. Okay, it's a little better than expected. That's good. We're on the right track. But let's not fool ourselves. An 8.5% CPI is ridiculously high, okay? And that's even with the fact that, most people feel like the government kind of cheats those numbers through all these different kind of tactics and things like that. And so the real number is probably 10% plus. Like, regardless of the number, is still insanely high. Next month, hopefully we come at maybe like a 7.9 or 7.7, something like that. Still insanely high. So it's like, yeah, we're making some progress potentially now, but let's not fool ourselves. These numbers are still ridiculously high, and inflation is still a massive problem. It's going to be a problem for this entire year. I think the biggest question is it a problem for 2023? And I think that's going to be what drives the stock market in 2023, either to the downside or upside. Does inflation stick throughout 23 and the Fed just has to keep raising rates and we have to keep trying to basically hurt the economy, or does the inflation rate continue to come down and we get into a better scenario?
You turn around. He's right next to me. I will tell you, last summer, the only person talking about stagflation that I remember was Danny Moses. It's right before us now. So my question to you, Danny, with 2s, 10s going to 50 basis points inverted, there's no arrows in the quiver of the Federal Reserve to fight this. And they can say they're going to pivot, they're going to pause. But if they do that, commodities go back up and the inflation problem continues. How do they get out of this mess?
I mean, they're just, they're certainly going to pause at some point. But why would they pause? Is it because inflation's coming down or things just are stuck in the mud? I think it's probably a combination of both. I think we've seen peak inflation, but I don't know what they can do. They're unwinding an 18.
That's important, what Danny Moses just said. He said, I think we've seen peak inflation. And just in case anybody's confused about that, that does not mean magically like we're at no inflation in the numbers or something like that. What he means is in terms of the rate of increase. And we hit over a 9% number last month, and now we're at 8.5. So he believes like we've already peaked now inflation-wise in terms of that rate of increase. It doesn't mean he believes that we're going to get into deflation or something like that. Obviously, he thinks we're going to continue to have inflation, but I think that's just important to understand that. And it's important to understand that he thinks the worst is behind us with that rate of increase, okay?
$1 trillion balance sheet here. So I tell people this is a little bit of the 70s, 80s, 90s, 2000s. It's all kind of mixed in, but there is no precedent for what we are seeing right now. And look what has already happened with the Fed having done very little. I mean, already the builders have gotten hit. You see what's going on in that sector. So the consumer's starting to feel it. And with savings rates where they are right now, where they've dropped, there's not a lot of margin for error here on the consumer side. So.
Yeah, going into this year, and I remember I said this on Millennial Money back when we had this show, and Kevin and everybody was on that show. This was at the end of 2021. I said my biggest concern for the economy in 2022 was going to be the middle class, because inflation was starting to really ramp up in a meaningful way. And if you just run the numbers, like the less income you have, the more inflation hits you. That's just the way it works, essentially. My biggest worry for 2023, and I know that seems a long time away because we're only in August right now as I record this video. My biggest worry for 2023 is the real estate market. We're already seeing considerable weakness there, and I'm very worried about the home builders. I'm very worried, and not from the standpoint of like their stock prices and what their revenues are. I care less about that. What I'm worried about is how many direct and indirect jobs basically are fed through the real estate industry. When you understand like what it takes to build a house, and you understand how many jobs building a home creates, and when you understand how many people make money and how many direct and indirect jobs this thing behind you, it's insane. Somebody makes that table over there and that table over there and the chairs that everybody always says I have too many chairs, right? And somebody's got to make this chandelier up here, and they make money, and somebody made this TV here, and somebody made this fireplace here, and somebody, had to transport all this wood to build this house, right? And the painters made money off this, and the flooring company made money off this, right? And the countertop people, they made money off this. Like when you go into it, it's a huge, huge process. In the backyard, people all make money. If real estate comes to a grinding halt, which we'll see what happens with that, but if mortgage rates continue to go up, it's going to come to a grinding halt with the fact that things are already unaffordable as it is, right? So many people are out of work, and that's just a very bad thing for the economy. That's part of the reason why we had such a deep, long recession and the great financial crisis is we killed the real estate industry. The real estate industry was dead for like 3 or 4 years. And if that's the scenario, there's a lot of people are going to be out of work, man. That's just how this works. And so I'm glad he didn't really elaborate on that point, but I'm glad he at least brought that up there for a moment.
So you spoke to employment a bit earlier. And so what we've seen so far is the unemployment or the peaking of unemployment that we're seeing is more so in the tech sector versus, the spending power is really being challenged in the lower third of the consumer base. What is it that the Fed needs to see from an employment standpoint in that middle third to upper third to get the people that are clamoring for this pivot to have something to kind of hang their hat on?
Yeah, I don't think they care so much about the middle and upper third. I think Walmart customer and Walmart told you the day before the Fed went. I think part of that pre-announcement was to announce to the Fed, look what's going on. We're going to tell you right now, the consumer is struggling. They're spending all their money on gas and food, and there's really nothing left. And so Fed is certainly watching that. That's going to have an impact. But there are layoffs occurring in the middle to upper now for the first time, and those are high-paying jobs, and that will have an impact, I think, on the market that we've yet to see. So this lag effect is now, I think, going to come around here.
So, Danny, you just said that
the belief is, we're in terms of job losses, it's more of a what they call white-collar recession, which versus like a blue-collar recession. So a blue-collar recession would be, the waitress loses her job, waiting tables or whatever, right? And the busboy doesn't have work, versus maybe, somebody that's in the management at a company being let go, let's say, for instance. And so, or somebody in the marketing department for that restaurant company being let go. So, yeah, that's kind of the difference there. Definitely jobs are still plentiful out there, but the worry is that, it's just lower paying jobs now at this point in time. And a lot of the, let's call them higher paying jobs, those companies have pulled back massively. And maybe they're at a point where they're either not hiring or they're only hiring the absolute best. And if they don't fit that criteria right now, they're kind of like, whatever, which is a very different environment than what we've been in the past several years, where it's been an environment where it's like, hire everybody you can, basically.
Whistling through the graveyard. What is that? Like the Big Short thing? What are they missing? We just said the S&P just rallied 15%. That's one heck of a rally in a very short period of time, right? And so the NASDAQ, again, do you see today the market felt really sloppy? The NASDAQ was down 1.5%. But you know what? Microsoft and Apple were unched on the day, unchanged. It was keeping the S&P together here. So what, it really feels like, again, there's a lot of people calling for bottoms, that sort of thing. What are investors missing right here?
I think you can own the quality. I think you're going to see those stocks traded at a premium to the historical valuations because they're going to hide in them. these meme stocks, which I call obsessments, not investments, is really what they are. I don't even watch. I mean, watch them to indicate the health of the retail investor, but there's not healthy what you see. Those are not healthy moves in Bed Bath & Beyond, AMC, GameStop. They're just not. And we know where they're going to end, or at least I think I know where they're going to end in. And so you want to
hold on. My opinion on this is I actually don't think it's retail push. Although retail might hold some of these stocks, Bed Bath & Beyond, AMC. I think when you get these massive moves, I don't think that's magically retail all of a sudden has a ton of money to flood in these stocks. What I personally think that is, I think that's Wall Street. I think that's hedge funds screwing around. They're the only ones that have that sort of money to just flood into a stock. I don't think retail's sitting on the sideline with just fortunes of money right now. They're like, what do I do with? Oh, let me throw it in AMC stock. I don't think that's a situation at all. You got a ton of people that still hold stocks like that. But in terms of just flooding in money because they magically have a bunch of money, no, that's not the way this works. And so, in my personal opinion, I think that's actually hedge funds playing around and getting a little arbitrage there. That's my personal opinion. Just the numbers, you add up the numbers, and it's like some of these market caps aren't small. Look at AMC's market cap. I'm telling you, man, you got to have some serious dough to push around. So they try to pin it on, it's retail causing the stock to go crazy today or yesterday or whatever, right? I don't know if I believe that. I think it's a little hedge fund activity. Believe me, hedge funds, they like that money just as much as anybody else, and they'll play games.
Own companies with strong fundamentals. You want to own companies with good, solid cash in their balance sheet, not lots of debt, because that's a whole other area that we can talk about maybe in a different episode, is what's going to happen when corporations need to come back for paper to fund their balance sheets. It's going to be a lot more expensive this time around. So those are all things that have yet to come, and I think that's coming on the horizon.
Is there a big short in your portfolio now? And I'm just saying, like, relative to other positions.
You're baiting me now.
Not necessarily.
There's one. There's one.
Well, listen, I'll just say, listen, Tesla, to me, is everything about this market that has been wrong. It's been bad enforcement by the government, capital markets, brokers writing research that, obviously for banking fees and so forth. And
what is and I don't want to hear what he has to say, but what is the obsession with shorting Tesla? Like, why do these guys year after year after year after year try to get this? I mean, everybody wants to slay the dragon. Oh my gosh, there's so many, I think, in my opinion, there's always so many short opportunities in the market. But why try to slay this dragon that has such an incredible brand, such an incredible demand, an incredible CEO who can, always puts himself in kind of the best position, even when he seems to put himself in the worst position. Like, what is that level of obsession? I just want to understand that. And I've been in this stock for so many years, and I've just tried to understand that obsession. I feel like at some point, it's not about even making money. I think it's about ego. That's what I honestly think it is. I think, everybody wants to be like, I shorted Tesla and then it went down 50%, 60%, whatever. And I'm just like, of the opportunities you have at your disposal to short, what is the obsession? And these guys have been doing it for so many years. And, the shorts have lost, obviously, fortunes on the stock for years and years and years. And so, I don't know, man. It's a funny obsession to kind of watch play out. It's one of those things, if you don't want to hold Tesla stock, you don't want to own it, fair play, but shorting it, man, oh man.
When that thing finally breaks, if it ever does, and been wrong for a long time, but if and when it does, I think we'll know that the market has corrected itself, because it has a little bit of everything in this market.
So this is a short position in your portfolio?
Tesla is a short position in my portfolio.
Since what level?
Well,
because a lot of people have gone broke shorting Tesla.
Absolutely.
Right?
I have not. So I made money initially years ago when after the Solar City acquisition. I thought for sure.
Look at this guy.
So look at this guy. I mean, this is a.
Look at this guy. Look at this guy. Oh, the face. Oh man, it's too good.
It's been a war.
Decade-long.
It's been a war. I've traded. I haven't traded as well as I probably should have, but now I think I'm geared up to a level where I'm very comfortable being short at these levels. So.
Okay.
All right.
Danny, good to see you. Thank you.
Oh, gosh. I just think about things that could potentially age bad, man. Who knows? Obviously, if the economy gets much worse, maybe Tesla's numbers aren't there over the next, let's say, year or whatever. It's definitely always a possibility. But I just think it's one thing to be a little like, I'm not bullish on that stock, but it's another to short it. It's just. In that stock, we've just seen the obliteration happen. And it's just, like I said, I think it comes back to ego more than money. It really does.
Danny
Thank you, guys.
Moses. Julie Beal, what do you think, particularly about the consumer, the effects yet to come, the lag effect of the Fed's rate hikes?
Yeah, I completely agree. I think this is the time to be in quality. I think from a valuation standpoint, the rally that we've seen has really left quality behind. And so you can actually find good value there right now. For sure, I don't want anything that has a lot of leverage. I think that's very underappreciated by the market is how many of these companies have either variable rate maturities or maturities that are coming due relatively soon. And it's going to be a very different world for them coming back to the capital markets. And similarly, I think most of these tech businesses that are run by, young CEOs, they've never been a manager in a recession. They're going to come across a very different world when they can't just get their way out of trouble by buying ping pong tables and beer taps. It's a new world for them.
Dan.
Yeah. Well, I mean, I think the quality thing is a really good point. I mean, Danny just said that those names that are going to continue to be crowded in are going to trade at multiples. So if you want to get worried about, Apple at 27 times or whatever it is for like low single digit revenue growth, I mean, again, we've all made that case again and again, but that stock did sell off 30% or so from its highs. The problem is it just rallied back. It's down single digits percent on the year. And I think you might see, you might see a lot of those smaller stuff that Julie just mentioned. That stuff is already down 60, 70, 80%. You know what I mean? So I don't just think that they're particularly interesting.
Great point. That's a great point he brings out there, and it's very important because you hear this all the time. Oh, you want to be in quality. And basically what they're talking about is quality is old established companies that obviously are super profitable. Apple, Google, sometimes they throw Meta in there. Amazon depends. Microsoft, they always throw these same exact stocks, right? And maybe some of the Coca-Cola, Pepsis, and those sorts of stocks. And that's what they kind of always preach, because if the market's going up high and let's say the more speculative stocks are doing well, then a lot of folks on Wall Street are like, oh, you don't want to play those, they're overvalued. But then if they drop massively, then they still tell you don't get in any of those stocks because it's dangerous. So it's just an interesting environment. And a lot of the more speculative stocks, those stocks we've seen it, man. They're down 60, 70, 80%, some of them 90% plus, right? And yeah, some of them have come back over the past month, but most of them are still down massively. So keep that in mind.
I do think, though, that we're going to have an opportunity in the not so distant future where we see some of these big NASDAQ names that make up a huge percentage of the major large cap indices. They're going to show really good relative strength. And we're going to see all those names that have rallied 30, 40% off their lows, right? Or that are down 60, 70% from their highs. They're going to retest those lows really soon, and that's going to be the moment of the truth for the stock market in general, and that's probably going to happen in the next few months.
Yeah, I appreciate that perspective there. I would love to hear your guys' opinion on all this as well, and kind of hear what you guys have to say and your opinion on the whole thing. So hope you guys enjoyed this video. As always, if you're looking to join my private stock group and get access to the private Discord chat, get access to all my courses, which is like Dividend Investing Mastery, Becoming Master of the Stock Market, Thriving in a Recession, the Millionaire Playbook, all those sorts of things. If you're looking to apply and join us in there, check out the pinned comment to fill out an application, and we'll see if we can get you in there. Much love as always, and have a great day.